What if the greatest capital allocator of the last century woke up tomorrow and found himself running the most controversial company of the next one? No memes, no cult, no moonshots justified by belief alone. Just cold discipline, cash flow logic, risk margins. Now ask yourself this: would Tesla become safer, or would it cease to exist at all? Because some companies don't survive optimization, they survive contradiction. And this is Dark Alpha, where value meets velocity. This question matters more than it sounds. Not because it's about Warren Buffett, not because it's about Elon Musk, but because it exposes a fault line running through modern capitalism. On one side, you have capital discipline, patience, predictability, compounding, protection against permanent loss. On the other, you have capital aggression, speed, optionality, narrative power, and the willingness to operate at the edge of failure. Most investors assume these are just different styles. They're not. They are incompatible worldviews about how value is created. Tesla sits at the center of that conflict. It's not just a car company. It's not just a tech company. It's a capital experiment scaled to $1 trillion audience. If you misread this experiment, you don't just misprice one stock. You misunderstand how modern empires are being built. And the cost of that misunderstanding is subtle. You allocate capital to the wrong timelines. You demand profits too early, or tolerate losses too long. You optimize for safety in a system that rewards asymmetry. This episode is not about deciding who is right. It's about understanding why some outcomes only exist because traditional investment logic was violated, repeatedly, publicly, and at scale. If you want to navigate the next decade of capital, power, and technology, you need to understand why Buffett's rules work perfectly, until they don't, and why Musk's methods look reckless, until they reshape the playing field. Miss this, and you're not just late. You're playing the wrong game. Let's strip this down to first principles. Warren Buffett does not invest in ideas. He invests in systems that already work. Predictable demand, durable competitive advantage, management that treats capital as scarce, businesses that can grow without reinvention. Buffett's genius isn't stock picking. It's time compression. He avoids uncertainty so effectively that compounding does the rest. No heroics, no reinvention cycles, no dependence on technological miracles. Elon Musk operates from the opposite assumption. He assumes the existing system is broken, and that capital should be used to bend reality, not reflect it. Tesla was not built to satisfy discounted cash flow models. It was built to force new ones into existence. This difference matters because capital markets are not neutral. They reward behavior. Buffett's approach rewards consistency and restraint. Musk's approach rewards belief and endurance. And Tesla only exists because the market tolerated something Buffett would never allow. Years of negative free cash flow, repeated dilution, operational chaos justified by a future that did not yet exist. Traditional analysis would have killed Tesla multiple times over, rationally, cleanly, with good intentions. But here's the tension. If Buffett's discipline had been applied from day one, Tesla would have been a better business, but a worse force. Less ambitious, less disruptive, less dangerous. The episode today isn't hypothetical in a playful sense. It's structural. Because the same conflict now defines AI labs, space infrastructure, energy transitions, and sovereign tech plays. The question is no longer whether capital discipline works. It does. The real question is when discipline becomes a constraint, not a protection. Tesla is the cleanest case study we have, and Buffett is the clearest lens to examine it through. Buffett's discipline would have made Tesla rational. And that's the problem. If Warren Buffett ran Tesla, the first thing he would do is slow it down. Not because he dislikes ambition, but because he dislikes unnecessary risk. Capital to Buffett is not fuel. It's inventory. Finite. Precious. To be deployed only when the return profile is asymmetric and visible. Tesla violates this philosophy at every layer. Start with manufacturing. Buffett prefers businesses that don't need constant reinvention of their production processes. Coca-Cola does not redesign its factories every 3 years. BNSF does not gamble on unproven logistics architectures. Tesla does both, continuously. Gigafactories are not just scale plays. They are experimental systems, new battery chemistries, new assembly methods, vertical integration where outsourcing would be safer. From a Buffett lens, this is capital inefficiency masquerading as innovation. Every redesign resets the learning curve. Every new process introduces execution risk. Every dollar spent before demand is proven increases the margin for permanent loss. Buffett would ask a simple question. Why not wait? Why not let suppliers mature? Why not let technology stabilize? Why not let competitors prove demand at scale? And this is where Tesla's logic diverges completely, because waiting would have killed the advantage. Tesla didn't win because it had better cars. It won because it compressed time. By building infrastructure ahead of demand, Tesla forced the ecosystem to respond to it, not the other way around. Charging networks, battery supply chains, software-defined vehicles. These are not features, they are control points. Buffett avoids control points that require upfront losses. Musk seeks them. Now look at pricing behavior. Buffett favors pricing power expressed through stability, a company that can raise prices quietly without demand destruction. Tesla's pricing has been volatile. Aggressive cuts, sudden adjustments, margin sacrifices. From a Buffett perspective, this signals weakness, inconsistent mode, demand sensitivity. But from Musk's perspective, pricing is a weapon. Lower prices squeeze competitors with weaker balance sheets. They force consolidation. They trade short-term margins for long-term dominance. This is not irrational. It's temporal arbitrage. Buffett arbitrages certainty over time. Musk arbitrages time over certainty. Midway through this analysis, here's the twist most people miss. Buffett's discipline is optimized for preserving capital in known games. Tesla is playing a game that didn't exist yet. If Buffett had enforced his rules early, no excessive dilution, no prolonged losses, no speculative expansion, Tesla would have looked healthier on paper. But it would not have built the infrastructure that made competition structurally difficult. It would have ceded the future to slower, safer incumbents. Buffett's framework minimizes regret. Musk's framework accepts it and uses it. This is the uncomfortable truth. Some monopolies can only be built inefficiently, and Tesla's inefficiency was not accidental. It was strategic. Buffett versus Musk is not skill versus chaos. It's time versus belief. The temptation is to frame this as discipline versus recklessness. That's lazy. The real contrast is how each man treats time. Buffett treats time as a multiplier. You get paid for patience. Musk treats time as an enemy. You win by outrunning it. Buffett waits for probabilities to resolve. Musk forces resolution through action. Look at capital raising. Buffett avoids dilution almost religiously. He sees it as an admission of failure. Musk uses dilution as a tool, a way to buy time, scale belief, and survive long enough for the curve to bend. From a Buffett lens, this is value destruction. From a Musk lens, it's optionality creation. Neither is inherently wrong. They are optimized for different environments. Buffett thrives in markets where the rules are stable. Musk thrives where the rules are being rewritten. Now consider governance. Buffett values decentralization and trust. Managers operate independently within clear constraints. Tesla is centralized to an extreme. Decisions flow through Musk. Speed overrides consensus. Buffett would see keyman risk. Musk sees velocity. The trade-off is obvious. Stability versus responsiveness. And now the deeper layer. Buffett invests where belief is unnecessary. Musk builds where belief is mandatory. Tesla required investors to tolerate years of losses, ridicule, and uncertainty. That tolerance was not rational in a traditional sense. It was psychological capital. Buffett avoids businesses that require continuous narrative reinforcement. Musk weaponizes narrative as part of the business model. Again, not hype. Coordination. Belief kept capital flowing long enough for reality to catch up. If Buffett had imposed his standards, Tesla would have been forced to prove itself earlier, with tools it did not yet have. That's the paradox. Buffett's logic protects investors from bad outcomes. Musk's logic makes improbable outcomes possible. One minimizes downside. The other maximizes the probability of a category-defining win. There is no winner here, only trade-offs. If Buffett's model dominates, capital flows toward predictability. You get fewer Teslas, fewer SpaceXs, fewer systems that reshape infrastructure. You get efficiency, stability, lower volatility, but you also get slower transitions, incremental progress, incumbents that optimize yesterday. If Musk's model dominates, capital flows toward belief-driven ventures. You get faster change, bigger failures, higher inequality of outcomes, a few massive winners, many silent losses. Capital becomes less about valuation and more about narrative endurance. This changes who benefits. Retail investors often enter late, absorbing volatility. Early believers capture asymmetric upside. Institutions struggle to model risk. Founders gain leverage. Capital allocation becomes ideological. And structurally, capitalism shifts from ownership of assets to ownership of futures. Tesla sits at that inflection point. It forced markets to tolerate behavior that would once have been punished. And in doing so, it reset expectations for what growth companies are allowed to do. The danger is not Musk's model. It's misapplying it. When belief replaces discipline without eventual convergence to reality, capital is destroyed. When discipline is applied too early, futures are never built. Understanding this balance is now a core skill, not a philosophical debate. So here's the unresolved tension. What if the next Tesla cannot be built under Buffett's rules, but also cannot survive under Musk's forever? What if the future requires temporary irrationality, followed by ruthless discipline? The market is not asking you to choose a hero. It's asking you to choose a timeline, short-term truth, or long-term possibility. Buffett teaches us how to protect capital. Musk shows us how capital sometimes has to be endangered to matter. And the most dangerous mistake isn't backing the wrong philosophy. It's applying the right one at the wrong time. Because in the end, capital doesn't just fund companies. It funds beliefs about the future. And not all beliefs deserve patience. But some futures only exist because someone refused to wait. That tension isn't going away. It's accelerating.